Shares of MGM Resorts dropped 6% on Wednesday after the company reported fourth quarter 2023 earnings results. And I thought the results were pretty solid, but the market obviously disagreed. And the biggest reason it seems is because of relatively weak results in regional casinos. MGM basically has three operating segments. You have the regional casinos, which are in Detroit, Washington, D.C., kind of spread out all over the country. Then you have Las Vegas, which is obviously the company's biggest market, and then Macao, where it owns 56% of the subsidiary there. There are a couple of other areas where it's expanding, like in Dubai, it's building another resort in Japan, but those are really the three main operating segments. And so that's how results are broken out. And if you look at the results, I think there's a lot of strong momentum both in Las Vegas and then also in Macao. Regional gaming is hitting kind of its own regional specific wall. And I'll get to that in just a second, why I think the market is overlooking this. But the thing to think about for MGM Resorts is what are they going to do with all of the cash that they're generating? They bought back 14% of the shares outstanding in 2023. And management basically said they're going to do something similar, although maybe not quite to the same scale in 2024. So that's what I'm going to dig into today, what the results look like and how we should be looking at the stock going forward. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they will give you their top 10 stocks to buy right now. So let's go right to the results. And I'm going to focus primarily on the presentation. And the reason I'm going to focus here is because they give some nice context to what results looked like in the past. So I'll start with Las Vegas, and this is where you can see revenue has been very strong. This has been a consistent theme throughout the pandemic. I think the question for the fourth quarter was how strong were results going to be with the Formula One race. So there was a lot of disruptions in Las Vegas, but then as the numbers came out from Las Vegas and the Nevada Gaming Control Board, it looked like results were relatively strong from a casino perspective. Obviously, room rates were really high during the race, and that's what you would expect. But there was a little bit of weakness in kind of some of those mass market areas. So things like blackjack, a lot of the gains were actually made in baccarat. So really, really high-end players are typically playing games like baccarat, not blackjack. So there's a little bit of questions about what results were going to look like, but they were really solid, up from a year ago. So almost $2.4 billion worth of revenue, adjusted property EBITDA. So earnings before interest, taxes, depreciation, and rent. Rent is now a significant expense for MGM now that they have sold most of their properties and are renting those back from Vici Properties. But that was $864 million. So this is the proxy for cash flow from the result from each resort. And the margin there, you get 36.5%. So I think pretty solid results. Q4 2022 was a really good quarter. You have a little bit higher interest. You have a little bit higher labor costs. So what you're looking for from these results is that they just continue to be cash machines. And I think that's exactly what we're seeing in Las Vegas right now. Regional casinos, a little bit weaker. You can see that revenue was down from a year ago. As a result, adjusted property EBITDA was also down and margin declined as well. There were a couple of explanations for this. First of all, you had the strike in Detroit. So the auto workers strike. Not as much gaming happening specifically in MGM Detroit. The second thing that management talked about was weaker results in MGM National Harbor, so Washington, D.C. resort. And that's because there was basically a whale or a really big gambler that came through in Q4 2022, did not come back and lose the same amount of money in Q4 2023. So that was an outlier result, both from a revenue perspective and an EBITDA perspective, in the fourth quarter of 2022. So that's why the results looked a little bit weaker. Now, we could quibble with these numbers. I don't think it's really in question that the regional results are not all that strong, but I don't know that I was expecting strong results. And to be frank, long-term, I don't think this really matters. I don't think this is what's going to drive the stock higher or lower. There's regional operations. You want these to be kind of a funnel leading to Las Vegas. And you want them to just be steady cash generators. You don't necessarily need your growth from Las Vegas. And look at the difference in the scale. Las Vegas generating $864 million in property EBITDA. Regional results, $233 million. So where would you rather have growth? You would much rather have growth in Las Vegas from that bigger base than you would in the regional casinos. Not saying they're not important, but I think the fact that the stock is dropping as much as it is based on this small segment is a little bit strange for the market. If we go over to MGM China, This is the Macao resorts. You can see that revenue was up to $983 million. Adjusted EBITDA, $262 million. And now this is just 2 resorts. And like I said, MGM owns 56% of these resorts. So what they do is they typically get a dividend from MGM China, but the results are consolidated in their financial reporting. And this, again, revenue growth and EBITDA is in line with what we've seen from increased revenue and casino spend in Macau, which is reported on a monthly basis. So this is what you would expect, is to see relatively strong results. Management talked a lot on the conference call about how they're taking market share in Macau. So that's a really strong sign. And I think as Macau continues to recover, this is again just going to be a cash flow machine for MGM. I'll cover BetMGM briefly. This is the subsidiary 50% owned by MGM that is the gaming business in the US. And you can see here that their iGaming market share has fallen a little bit, likely to DraftKings. And so they're now the number 3 position there. This is, again, something that management talked about. A lot of their competitors are spending a ton of money on customer acquisition, so sales and marketing, and they're deciding to focus on profitability. So we'll see how this plays out long term. But as a shareholder, I am not really concerned about them losing market share as long as they're not losing money, which most of these companies are. Same thing goes for sports betting, number 3 position in the market. And this is obviously DraftKings and FanDuel, who are really battling over that number 1 position in the sports betting market. A few things that MGM is doing to improve this: they're integrating their back end across the country. So you're going to be able to open an account in Las Vegas and then take that same account home and be able to gamble in your home area if it's legal where you live. And as more states are allowing gambling, that's going to be more and more places. The other thing I wanted to cover briefly is the balance sheet. About $3 billion worth of cash on the balance sheet. They do need to have a lot of cash on the balance sheet to continue operations. You need to have a whole bunch of money to cover any potential losses that you would have on the casino floor. So there's a lot of working capital that it takes to just operate the business. So you expect to see that number to be pretty high, but long-term debt is starting to come down. $6.3 billion in the most recent quarter, and that's down over $1 billion from a year ago. So that's what you want to see from MGM, is reduce that leverage and then continue to buy back stocks, which I'll get to in just a second. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So one of the reasons that I've liked MGM Resorts is I think it's a really good value for investors given the amount of cash flow that's coming off of these casinos. The way that the casino business has evolved over the past few decades is that companies would take the cash flow that casinos are generating, and then they would just simply put it into building the next casino. They would lever that up by taking out a bunch of debt, and you'd continue this over and over and over again. Now, where we are in 2024 is there's not a lot of opportunities to grow the casino business, to build new casinos. There's been 2 casinos opened in the last few years in Las Vegas, and those were started before the financial crisis. So it took over a decade just to build those casinos. Same thing is happening in Macau. That is a supply constrained environment because the government controls how many casinos can be built. Same thing is happening in Japan, in Dubai, in New York, where MGM may be able to expand. You have to get all of those casinos approved by local regulators, and that's just not happening at a very high pace right now. So as a result, you have excess cash coming from the business because these casinos that you built for billions of dollars years ago, sometimes decades ago, are still generating cash year after year. And so what are you going to do with that cash? If you can't invest it in new resorts, you're going to invest it in things like paying down debt and buying back stock. I want to give a couple of quotes that CFO Jonathan Hawkyard gave during the conference call, because I think these are telling about what MGM is thinking about its cash in the future. It says that we bought back 14% of shares outstanding in 2023. $2.3 billion of stock was repurchased. And when they walk through the valuation and how they're thinking about the valuation multiple, you have a $15 billion market cap. Subtract out this 56% stake in MGM China, which is publicly traded, back out the 50% stake in BetMGM, and you get the value of operations of $10.6 billion. Divide that by the 2023 EBITDA number, and the multiple is just 4.9 times EBITDA. That's what shares are trading for right now. So what management is saying is it is a great use of our capital to just simply keep buying back stock. They did say that they're probably not going to buy back stock at a $2.3 billion pace in 2024, but with shares down and the market seemingly not really appreciating the cash flows coming from the business, I wouldn't be surprised if they get aggressive with buying back stock if the stock doesn't go anywhere in 2024. So this is what I'm looking out for. I'm more than happy for MGM Resorts to just be a company that's generating a ton of cash, riding the growth in the regions that it's in, Las Vegas and Macao, soon to be Japan, which will likely open in 2030, and then just use that excess cash to continue to buy back stock. If they reduce shares outstanding in the 10 to 15% range year after year, that is a phenomenal path to value generation for shareholders. May not be what investors are typically looking for, but I'm more than happy for them to buy back shares at the current price, given what I think is a relatively low multiple. But what do you think about MGM Resorts stock? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next.